Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Edison International, ticker EIX. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $23 billion, enterprise value of $48 billion, which means that you have about $25 billion in net debt on this business. So there is more debt on this business than equity because the debt is a larger percentage of the enterprise value than the equity. That is an absolutely huge amount of leverage. Now, it makes sense in some ways because this is an electric utility company. They tend to have a lot of leverage, but that is still significant. So this company distributes electric power, has electricity to 15 million residential, commercial, industrial, public authorities, agriculture across South, Southern, Central, and Coastal California. Now, this is probably a really tough area to be operating in and regulated, highly regulated state. So they provide energy solutions to commercial and industrial users, has transmission facilities, and has 39,000 circuit miles of overhead lines, 31,000 underground lines, 800 substations, and headquartered in California. So California Electric Power Utility Company tells you a little bit about them there. So the beta of 0.744 means they're about 26% less volatile than the average S&P 500 company. Now let's take a look at the return on invested capital. I'm a little surprised at what looks like a cyclical nature to this business. Now, it could be due to maybe some natural gas generation or coal generation exposure to commodity prices is kind of what this looks like here, because you're seeing some very clear cycles in their return on invested capital. Now, they lost money, it looks like, in 2012. They basically broke even in 2011, lost money in 2018. So they lost money in 2 out of the last 20 years, kind of just below the threshold I like to see of 19 or 20 years of profitability. But what's really concerning to me is twofold on this return on invested capital. One, that it's cyclical. You don't like cyclical companies, and it's a little surprising because utility companies are supposed to be a little less cyclical than the average company, but they clearly have multiple cycles here across the decades. Second, that your return on invested capital peaks at 6% in 2014. You really don't have a very high return on invested capital, and the last 2 years has been 2%. 2% is a terrible return on invested capital. I mean, that means for every dollar invested in the business, you're getting 2 cents of profit out of the business. That's really low. Also, because half of the business is owned by debt holders, you're having to split that between the debt holders. So you have like 1 penny in profits for every dollar invested in the business contained for shareholders, which is pretty bleak. So far, this is looking like a below average business, both because it's cyclical and because the return on invested capital is just simply so low. Likewise, when you see this return on assets number of 1.8%, return on invested capital averaging 3%, again, these are low numbers. You think about what returns you want as an investor, and presumably you want higher returns than this. Likewise, the return on equity of 7%. Return on equity tends to be the upper end cap of what you should expect as your return as a shareholder if you held for the long term, 10, 20, 30 years. So you're thinking that the cap of your return as a shareholder is 7%. Now, it's likely to be worse than this. This is your upper end estimate. Now, you're currently paying a PE of 25 for this business. So that means your current earnings yield is 4%, which means a general baseline estimate should be that you're expecting 4 to 7% returns on your investment if you buy this company. For me, that is simply too low. I want to buy stocks with a 10 to 15% rate of return, and to have the option of 4 to 7% doesn't make me excited, especially when I'm thinking about this being a below average business. If this was a super high quality business, that would be one thing. I might be willing to trade in some lower returns. But for a low quality business to only get offered 4 to 7% returns, I'm not excited at this point. Now, revenue, which what I'm saying here for this PE ratios is that this price to earnings is clearly overvalued. We can take a quick look and you can see that for the last 5 years, I mean, a $2 EPS is kind of an average. So it's not like that's an abnormal number that you're looking at here. And really, it's just saying that, you know, really the overvaluation is definitely here. Price to book of 1.3. You need to think about price to book in the sense that if you bought it at book, you would expect like a 7% return because the book is equal to your equity. But because you're buying above book, you should expect a below 7% return. So if you want a 10% return, you need to be buying something like 2/3 of book value or half of book value, which would be 0.5 or 0.67. Either way, you're paying way too much for this business. Now, revenue growth. You do have revenue growth of 3 to 4%. It might actually be a little bit higher than that, but you do have some years of declines. That's a reasonable amount of revenue growth. What I don't like, and this is what's causing this decline in return on invested capital, is you're growing your assets faster than your revenue. Now, what's interesting is you're not calculating a 10-year CAGR on free cash flow or your EPS, and that's because you lost money in 2012. So we need to take a deeper look in the income statement to get a better idea of what's really going on with your profit growth. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. Your subscriptions and likes tell YouTube that you're enjoying my content. So if you're a long-time listener, please hit those likes every video. And if you're new to the channel, I hope you'll stay tuned. There are certainly some companies I really enjoy, and even if this one's trending in the wrong direction at this point. So SG&A, something weird going on with the data here. You have like 5-6 years where it doesn't even show SG&A. Common for utility companies that earn low returns on capital is that you have dilution over time. You can see that they've grown to 380 million shares outstanding. They started with 330, so you have about 15% growth in your shares outstanding over the last decade. That basically means you're going to have 1 to 2% dilution every year. That's a 1 to 2% reduction in your return every year, which is actually very bad, because when you think about that, you're only getting revenue growth of 3.5%. So if you say, okay, I'm growing revenue growth of 3.5%, I'm diluting by 1.5%, that's trending towards like a 2% annual return on your investment. That's pretty low. One thing that's a significantly negative thing here as well is when you look at operating profit. Just look at operating profit for 2012 to 2014. 2.2 billion, 2.2 billion, 2.6 billion. And then look at operating profit for the last 3 years. 1.9, 900, 1.5. Your operating profit is lower today than it was 10 years ago. That means that your revenues, that your profitability is getting worse and worse and worse. That's a major concern, and it's really coming down to how the business being management, because you started out with $4 billion in gross profit. You've grown the gross profit to $5.7 billion. The only reason you would have lower operating profit today is because the business is being mismanaged with its operating expenses. The expenses are simply too high for the profitability of the business, and shareholders are being punished accordingly. Balance sheet. So here's the problem, right? So you've doubled your PP&E, and you've cut your returns in half. I mean, PP&E, 27 billion, 52 billion. You have $52 billion in assets, and you're earning $1 billion in net income. That's your 2% return there, and it's terrible. This is a horrible return because all of these assets require maintenance. All these assets are going to require cash flow to be spent on them, and it's just being thrown into black hole. I mean, so many of the utility companies I look at have a lot of trouble coming up for shareholders, where you're expecting potentially no returns for the next decade because you're going to have to funnel money into maintenance. I mean, look at the debt. Your debt has exploded from 8.8 billion to 24 billion. So you've tripled your debt, but you cut your net income in half. You doubled your assets, you cut your net income in half. I mean, this is a poorly managed business that you do not want to be owning based upon what I'm seeing here. And if we look at our cash flow, take a look at this. You're spending more on your PP&E than your cash flow from operations every year. Every year. Is it every year? 1 year. In 2015, you didn't. Every single year. But certainly, you've basically averaged like $40 billion in investments in PP&E, and you've made less than $30 billion. I mean, it is a terrible indictment of the future of this company because of how much you're having to invest in the PP&E, and yet there's no free cash flow. So you don't have any money for buybacks. In fact, you're diluting the business. You don't have any money to buy back stock. You're constantly raising new debt. It's a miracle they've paid dividends at all, but basically in the next decade, you should expect dividends to get cut to zero, and the business is going to degrade because they can't continue reinvesting at this rate. And they're reinvesting at twice their depreciation and amortization, which means the true net income is probably zero or negative. This is going to end poorly. for shareholders. So I would absolutely avoid Edison International. I don't think the future looks good at all based upon the last 10 years. And so for me, not interesting, won't go on my watch list. Low quality company, way too high priced. It's amazing the company's trading at a PE of 25 based upon these financials. Like I said, I would avoid it. Thank you for listening. Until next, and don't forget to like the video, hit that subscribe button, ring the bell so you can get notified as I upload new videos each and every week. If you like this tool and you want to do quick 5 to 10 minute assessments of stocks, I encourage you to check out quickfs.net. My affiliate link is the first link in the description below. And if you use my link, that's a great way to support the channel because I can receive a commission when you sign up for a free or paid account. I would really appreciate your support. Thank you for listening, and until next time, stop paying fees, start building wealth.